This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the text!
This episode is brought to you by the Felder Report. Every week I go through a ton of reading and research materials, and every week I compile some of my favorite things that I've found during the course of the week and put them together in a Saturday morning email. A lot of times it's my favorite chart of the week or my favorite video, a tweet. Could be a link to a story that I found very interesting. If you're interested in receiving something like this, go to thefelderreport.com and you can sign up for the email right there on the homepage. My guest for this episode is my friend Eric Cinnamon, and Eric was my very first guest on the podcast. If you didn't listen to that episode, I really encourage you to go back. Eric is just a fascinating guy, super successful, small cap mutual fund manager, and in that conversation, I really picked his brain, and he was so generous to share with us his investment process, a lot of the details of that, how he values companies, and so forth. So if you've only started listening to this podcast recently, I really encourage you to go back and listen to that one. But in that earlier conversation, Eric mentioned that every single quarter he listens to 300 conference calls roughly, and makes notes. And so he gets a unique perspective on a lot of the trends that are affecting corporate America. And he and I have been conversing via email and such over the last few months. He's been blogging about it, about a theme he's noticing more and more among corporate America, and that's just rising costs, rising inflationary pressures. And so I thought I should have him back on the show so we can discuss this, and that's exactly what we did. So without further ado, please enjoy my conversation with Eric Cinnamon.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Eric Cinnamon, welcome back to the show, my friend.
Hey, Jesse. Long time no talk. It's good to be back.
Long time no talk on the podcast, but we have been in communication via email. And, the first time I had you on, I was really just curious to talk to you about your process, which, became a hugely popular episode. I think that was very valuable. But since then, it's probably been about a year. I've been, reading your blog and following all of your comments about what you read in the earnings reports. And actually in our first conversation, you mentioned that you go through about 300 every quarter. And I thought, man, how cool would it be to have Eric come on every quarter and just talk about what he's, reading through these reports. But especially because you found some common themes lately. So I thought this would be a great time to check back in with you and see kind of what you're seeing in those reports.
Yeah, well, I'm finishing up earnings season now. I probably have another 50 to go through, but I've probably gone through 150 or so. So I do have 300 names, but keep in mind that, some have different fiscal years than calendar years. So they don't all report, or the quarters don't end, March 31st, all of them.
Sure.
So the common theme I'm seeing right now has been really something I've been noticing since Q2 2017. And that has been rising corporate costs, labor, freight, raw materials, insurance, those type of things. I started noticing in Q2 2017, and it started to pick up steam in Q3 17, and then Q4 became very noticeable. And then Q1 2018, the quarter I just reviewed, again, the trend seems to be accelerating. So it's something I've been paying very closely attention to. Again, though, Q2 2017, at first I was like, I don't know if this is a sustainable trend, what exactly is going on. It's just something I need to watch. And, I've been focused on that a lot. I've been writing about it a lot. When I first started the blog, I talked a lot about process and, I had a lot of things in my mind. But lately, I'm talking more about what's going on with my opportunity set. So it's sort of a shift. The blog's taking a shift for, hopefully the better. Where I think I'm writing more about the businesses I follow, which I tend to enjoy a little more.
Yeah, well, there was a couple things you mentioned in those posts that, and I'm just going to quote you here. When developing my opinion on inflation, I prefer skipping the middleman. Wall Street economists and central bankers are going directly to the source, businesses operating in real time and in the real economy. And this is, to me, extremely valuable because, we see the CPI report, you see what the Fed is, saying about inflation and Wall Street economists. And they're all saying, yeah, it might be rising, but it's subdued, or it's just a temporary, uptick. How does that jibe with what you're seeing in the earnings reports?
Yeah, I mean, yesterday I was going through a call, and at the same time, I was watching Bloomberg TV. I had been going to Starbucks every morning, to my new office, Starbucks, but they raised the price of my favorite drink by 10%. so I decided to work more from home. And so I'm at home watching Bloomberg TV, and an economist comes on, and I didn't really look at the CPI report, but the economist starts to talk about inflation, or I don't know if it's core or the regular number. Again, I don't pay too close attention to it, but I think he said it was up 0.1%. And at the same time, I'm reading this call, and it's screaming inflation. It's saying how all their costs are going up and inflation is a real deal. And so I go, you know what? I'm going to write a post today. I don't have much time because I'm going through all these earnings reports. I'm going to write a post today. It's summarizing all the examples I have for this quarter so far. Again, I've probably been through 150 names, and I'm going to pull from there all the mentioning of cost pressures, pricing power, et cetera. And so I start doing this, and I think it'll take me 10, 15-minute posts. I mean, this is going to be pretty easy, right? So I start going through. I have about 100 pages of notes for my calls so far. Start going through these notes, trying to pull up the mentioning of inflation or cost. And before I know it, or not before I know it, 4 hours later, I'm still going through my notes because there's so many examples. There was over 70 really good ones I pulled out, and then it was over 12 pages of just one-liners, and so I didn't post it. It was too long.
Yeah.
But there's so many signs this quarter. Again, it builds each quarter, really from Q2 2017. I don't know what happened in 2017, but that's clearly when the trend changed. But this is from the post I was going to do, but I didn't. Here's just some examples. Aptar Group, they do dispensers, plastic dispensers, perfume, lotion, that kind of thing. It says, look, I think everybody who is following the current environment sees inflationary pressures coming, and there's no way to escape that. Fastenal, I mean, most of you know that company, one of the market leaders in fasteners. As you know, there's meaningful inflation going on in our business. Our labor costs continue to rise. Hubble, electric distribution products, they sell off the utilities. You can't, with this much inflation, you can't catch up overnight. Casey General Stores, the average price of fuel during the period increased 13%. RPC, Energy Service Company, everyone pretty famously knows about shortages of skilled labor and employment issues. Steinmart, we're selling a very strong regular price selling. Kirby Inland Barge Company, we saw a positive change in market dynamics during the quarter. Spot market pricing increased 10 to 15%. Patterson UTI, Energy Service Company, average operating costs, $14,000, due primarily to higher than expected labor costs. I mean, I could go on and on. And these aren't just cyclical companies. And there's many that are consumer businesses talking about rising costs and rising wages. So there's so many examples. I don't even have time. This is kind of interesting, really quick. Carter's Incorporated, they do baby clothing. That is normally a deflationary. You think about infant clothing, kids clothing. That has typically been deflationary. But they're saying in 2019, this may change. They'll say our teams are in Asia now negotiating spring 2019. We'll have more visibility to those costs in July. We are assuming over the next 5 years that we'll start to see some modest inflation. Our experience in recent years has been consistently lower product costs every year. But for modeling purposes, we're assuming modest inflation. There's a change in mindset in inflation now with these companies. And what's happening is a year ago, really 2015, 2016, that was more of a deflationary environment. But what's changed now is I think companies are more comfortable asking for an increase in price because, as a lot of these companies are saying, everyone knows, right? In the corporate world, everyone knows. The economists that focus on government data, we'll still talk about there not being inflation. But everyone in the corporate America, not everyone, but I think most of the companies that I follow are well aware of this.
Oh yeah. And I think you titled a post, it was perfect, the consumer last to know price index. And I think that's
right. But Jesse, there's a lag in inflation, right? I mean, it's a process. If you look at a lot of these companies, they'll openly talk about their pricing intentions. When their costs go up, they don't put in the price increase that day. It's very methodical. They have to talk to their customers, or their vendors, their suppliers are talking. And so it takes months to implement a price increase. So it doesn't happen right away. So I'm saying what I'm seeing now. Not only is a change of trend, I'm seeing it in the pipeline, right? And like you said, or maybe I said, the CPI is the last to know, but that's, I think, very true. But that's why you don't want to get behind the curve when it comes to inflation, right?
Right. And speaking of that, speaking to your first point, there was a great chart in the Wall Street Journal's The Daily Shot, which I read on a daily basis, just a rundown of great charts every day, showing the percent of firms planning to raise prices. And it usually leads, CPI, just like you're talking about. And it's the highest percentage of companies, since 2006-07. And so, yeah, they're very clear in their intentions. They're going to raise prices, and CPI is going to follow. But when people start, it's just crazy to me when I hear people saying that this is transitory, because these companies are talking about the tightest labor market in 20 years. And
I saw a chart recently. It was on Bloomberg. One of the what's your biggest issue right now? It was wages. And if you look through a lot of these calls, on when they're talking about cost, wages is a very big issue, and it's not just increasing wages; it's availability. And this is something I've also saw this quarter that I hadn't seen in the past. The mentioning of overtime. I mean, when's the last time you saw a company talking about overtime? So they're not able to find enough workers, so they're paying overtime instead of maybe finding someone less competent or less able to do the job. They're just paying people more internally. So I mean, it's great for the average worker. I mean, they are definitely due. This has been a horrible cycle for real wages. And it's been a great cycle for the one percenters. But so I mean, it's good news. But I think my point is things are tight. I'm even seeing capacity constrained comments. I mean, obviously we've talked about this, and we've emailed back and forth about transportation. Some on the spot market, transportation is the cost there up, over 20%. It's not like this capacity is just going to show up.
Right.
And it's a truck driver shortage. It was what's that call I read? It was Forward Air, and that was it. So their CEO was talking about. Someone asked him about expanding capacity and buying new equipment, and he said, I forget exactly how he said it, but if we can't get, he said fannies. If we can't get fannies in the seat, it doesn't matter how much equipment you have, right? So there's some real constraints here going on, and it's also the quality of labor. We just got a new dishwasher, and two guys came in. They both brought in the dishwasher. One guy immediately got on his phone, and had his headphones on and started looking down. I don't know what he was doing, and the other guy tried to install the dishwasher. Well, he was having trouble. And here I am going through the installation manual, like I know what I'm doing, but I'm trying to help him. so we got me and this guy trying to install the dishwasher and go through this manual. And I'm like, something is wrong here with the labor market. Yeah. And then so they leave and they didn't install it properly. And then we call a complaint. And then they send, you ever seen Pulp Fiction? When they send the wolf, that's who came next. The wolf came.
Oh, sure.
Yeah. The wolf just figured out right. that the factory had installed the drawers incorrectly. So it was a labor issue at the factory. So,
oh, geez.
Yeah. So the market is extremely tight. And I think if your listeners probably can relate to a lot of this, just finding good service right now is very difficult. We had that hurricane here, last year. It took us several months to get the repairs done, not because we weren't willing to pay for them, but we couldn't find the available labor.
Yeah, well, I'm seeing it in my life firsthand. My wife about a year ago went to work for local coffee company here, kind of on the management side. They have a few locations here in Bend and a few in Denver, and just, keeping people at those close to minimum wage jobs, baristas and things, has become a huge challenge for them. And then, my kids are 17 and 18. They both had, been working, jobs, at least in the summertime, the last couple of years, and they basically have their pick right now.
Oh yeah.
There's a pizza place here in town that's offering $15 an hour to wash dishes.
Right. No,
Jimmy John's,
15 is the new minimum wage. If you're a competent minimum wage employee, you can get 15 right now if you search. If you're not very capable, you can still get 12. It's not too bad.
Right. Well, yeah, and I told my kids, I think my wife saw an ad, Jimmy John's is right here by our house is hiring, and it's $15 an hour plus a $600 signing bonus.
Wow.
Just to make sandwiches.
That's
how
we're seeing signing bonuses now being advertised on the radio. I mean, pretty good ones. This is really funny. I was recently offered to interview for a CFO job. No kidding. And the lady offering me the interview said she got a bonus if I got the job.
Really?
Yeah. So I was like, I don't know. I really would like to run money again someday. But another thing, Jesse, I was just thinking, it's not just price too, right? All these companies, if they can't raise price, they're going to figure out a way to maintain their margins. And one of the ways they do that too is they re-engineer their product or service, or it's often called lightweighting. And I was thinking about the Bemis conference call I was on, and they do packaging, flexible materials for packaging. And this is a good quote. That's a normal part of our business processes. As contracts come up for renewal, customers are experiencing lower input, and that's part of our strategy. Is we are constantly working on lightweighting, down gauging, and other initiatives. Recognize that that's an expectation of their customers. So what they're saying is, if they can't pass on the price increase, they're going to find a way, again, lightweight that package. And I don't know if you've used a plastic spoon or fork lately, but they're no longer rigid. They're very flexible. You might have, they bend very easily. And that goes back to that resin prices increasing 10-50%, which I noticed on a lot of calls this quarter. And that will impact the durability of your plastic cutlery.
That's actually a really great point, because you mentioned in one of your blog posts, I'm trying to see which one it was. I think it was the which call was it? Was it UniFirst? No, I think it was it was the Lincoln call, where they said we're in a very rapidly increasing inflationary environment. But they made a point a couple of times to say that these are global inflationary pressures too. And, to me, that's interesting because, people have, think, oh, we're in this massive disinflationary, deflationary environment globally. But, I came across an article recently, a couple of things that are related to your point here. It was Japanese price hikes that we're seeing for the first time in 20 plus years. And another, I think this was another chart from the Daily Shot, Wall Street Journal, was showing people complaining about the quality of services in Japan. And so that companies there are just clearly, allowing the quality of service to deteriorate as a way to save on costs. And those are all point to the same, inflationary pressures.
I love when people talk about Japan. They always talk about deflation. If you pull up the most expensive places to live in the world, many of the cities are in Japan. Right. That's never made sense to me. Maybe they need a little deflation, right? It's a great point. It's a great point on services. And I saw recently on Bloomberg as well a headline come across saying incomes actually increased recently in Japan. So maybe they're finally getting what they're wishing for.
Yeah, there's another article that I saw. German government workers just passed 3% backdated wage hikes just across the board. Backdated to earlier this year. They get another 3% next year. that the German unions got passed. So, these things are not the kind of things that have happened for a long time. And I think it also, there was a great article that somebody pointed to me. I think it was Brett Freeze on Twitter, who Tex Global, I think is his Twitter account. He tweeted this article from the BIS, which also is totally contradictory to what people think about demographics and inflation. Is, everybody says, oh, an aging society is, deflationary, disinflationary. And the BIS wanted to look into this and see, is that actually true? And they found the exact opposite, that an aging society has a direct correlation with rising inflation. It's basically the dependency ratio. So the more dependence you have in an economy, the higher inflation you should expect in the economy. And you think about that, you have all these retiring, older people and not enough young people to take care of them. So, I mean, we've been seeing wage pressures in hospitals and nurses and those kinds of things for a long time. But it's just, it's interesting to me that, there was an article in the Wall Street Journal about the teenage population just being, so, not enough to supply these jobs. And that's where this, inflation's really, I think, coming from is these longer, demographics and dynamics. And so there's certainly a cyclical, aspect to it within, unemployment so low, but there's also, I think, secular forces too, probably at play.
Yeah, it's interesting. When I was a teenager, I got my first job at Baskin-Robbins, eventually worked my way up to head scoop. It was still to this day is probably my favorite job I've ever had. I was only paid, I think, $3.50 an hour, but the benefit was all the ice cream you could eat. But now teenagers could easily get $12, $15. I had a reader email me, tell me about his daughter's 13, and I'm not sure how, but she got a job making $15 an hour. So yeah, I think right now everyone talks about the labor participation rate. If you want a job right now, you can find a job, right? So if you're not working, there's something wrong. And for me, of course, that's asset prices, but there's, either you don't want to work or, you're waiting for even better wages. But if you're willing to apply yourself currently, I'm very confident you'd be able to find a job, a pretty good one too. If you put in some time to learn new skills.
Sure. Yeah. I mean, it's literally my kids are looking for their summer jobs right now. They haven't even applied anywhere, and they have people asking us, "Hey, are your kids available?" I mean, like literally, it's that
you're like their agents.
Yeah. Right.
But, Jesse, too, it's not like the Federal Reserve doesn't know this, because if you read their own beige book, I mean, they clearly talk about this. I pulled up last month's beige book. And that's sort of what they do, is sort of what I do with the conference calls, is they talk to business leaders and ask around and try to figure out what's going on in the real world. And they talk about labor, and they say outlooks remain positive, concerned about newly imposed and or proposed tariffs, gains notice in retail sales, mixed results vehicles, residential construction strong. But they say widespread employment growth continued. Labor markets across the country remain tight. There's difficulty finding qualified candidates across the board. Reports of labor shortages, reports of overtime, again, labor shortages. I mean, they must put this report on their desk, right? And then you assume they read it. And then you go back to the Fed funds rate at 1.5, 1.75. and we're openly talking about labor shortages and overtime. The last time I remember that was 1999, when wages were reported to be growing 4 to 5%. This is a very similar feel to it, to me anyways, in the late 90s, when labor was very tight. And this goes back to, Jesse, just talking about rates and valuations in the stock market, and it's something I wrote about, I think, in June or July of 2017. Going forward, the bond market and stock market are no longer buddies, right? They're no longer best friends. From here forward, because of where we are in the cycle, because of the tightness in the cycle, they're going to be adversaries. And that's what we've seen. We've seen short-term rates increase considerably. I know that the yield curve's flattened some. So when the stock market rises now, you're seeing that increase in short-term rates. So at some point, there's a breaking point, and I'm not sure when, but I'm very encouraged by it. I mean, one, I'm getting paid more to wait, but two, I'm more optimistic that this cycle is proceeding and eventually will end.
Yeah, there's a couple of things I thought of, while you were talking about, CPI. Everyone's focused on CPI, core CPI. The Fed, the New York Fed, puts out their underlying inflation gauge, which they use to determine sustainable trends in inflation. And this thing's going straight up right now. It's 3.2% for April. And that's, it's rarely been over 3% in the last 20 years. So, the last couple times were, 2005, 6, and then also right in 2000, late 99, early 2000, were the only two times in the last 20 years where the underlying inflation gauge was over 3% and rising. Mm-hmm. And so, yeah, they have to see it. They have to see it. And that's why, they're, trying to lay the groundwork for 4 hikes this year, or at least 3.
Well, and they're also laying the groundwork for inflation exceeding 2%, right? So, right. So we're talking about, it being symmetrical now, where before it was sort of a set target.
Yeah, I should just run the chart and look at that underlying inflation gauge versus the Fed funds rate, because that would probably be the visual depiction of what behind the curve looks like.
Right, and when you think about what the companies are talking about, when they're talking about price increases, it's not 0 to 2%. I did see some that were around 1, but most of them are like 2 to 5, I would say. And that's probably on average 3.5 is not probably bad. I think benchmark for inflation right now. And that sort of agrees with what you're saying.
Well, yeah, and there's also, you were talking about, stocks and bonds, not being buddies anymore. So yeah, we've had the risk-free rate, at least at the short end, has been 0 for the better part of a decade. Now you're having risk-free, rates of 2% plus. That's got to compete with risk assets.
Sure, most definitely. If you think about just the yield on the S&P 500, right? I know a lot of people talked about this, but you can get a 6-month T-bill now over 2% slightly. So the stock market is now competing with T-bills. Yeah,
and I think we're seeing that. One of the stocks that you mentioned, General Mills. You've suggested your readers go read that conference call, and consumer staple stocks are one of these groups that have been hammered in the market, and I think it's because they're at the epicenter of this inflation, but it's also because a lot of these stocks were bought just as income, as bond alternatives, right? People just bought them for the dividend, and they didn't even care, what's fair value for the stock. They're like, I want my 3% dividend.
That's right. They were looking at the dividend, and they were not looking at what is the appropriate discount rate for this business. And of course, when you calculate that, you should already assume, and this is why you don't discount rate. You don't use a discount rate of 3% for equities, right? There are risks to every business, and for these consumer staples, although they are lower risk businesses, they still have risk. And I think we're seeing that this quarter in a lot of earnings reports, where you're seeing industries. What was the private label food company, Treehouse Foods, I believe? They're talking about price increases, and I forgot what they said exactly, but something as if it's the first time the industry's raised prices. I want to say like in a decade. This is new. This is new to a lot of companies. Trying to figure out how to raise prices. It's so when I talk about inflation being in the pipeline. A lot of that is people having to revisit inflation because they haven't had to implement price increases for so long.
Right. And I keep hearing in the back of my head, people, I think, I don't know, we hear the term transitory, and every time I hear it, I'm just like, I don't know where that's coming from, because I guess I could see how people would say, okay, well, we're, late cycle. We just had some fiscal stimulus in the form of a tax cut. So this is just kind of a transitory uptick in inflation. But then when you hear what these companies are saying, it's certainly, more than a transitory, 1 or 2 quarter type thing. But the other thing I think about,
I agree.
Yeah, the BIS pointed out these demographic forces, the secular forces of inflation mean that, it makes perfect sense when you think about it. You had the baby boom, and when those people entered the labor force, it was a huge supply of labor that came on the market that kind of depressed the cost of labor. And now those forces are reversing, and they're saying over instead of a 35 year disinflationary trend, we're looking at a 20, 30 year inflationary trend just based on demographics. So, I think it's important to distinguish between the secular and cyclical, or secular. But there's also, to me, this fits perfectly, like you're talking about, stocks and bonds and the interrelation. The Fed, I think it was the San Francisco Fed, came out with a study a few years ago that showed demographics and stock market valuations, and the PE ratio is really highly correlated over long periods of time with the size of the population entering their peak earning years. And it shows that, baby boomers hit their peak earning years right during the dot-com mania. And that's no coincidence, right? That they're saving and investing their peak amounts right when stock prices go nuts. And that demographic, kind of the other side of that, as it moves through the boa constrictor, it's 2025, 26 is, they said if this relationship holds up between valuations and demographics, they forecast a PE of 8 on the S&P 500 in 2026.
I think you just gave me goosebumps. 8 multiple. I'll take it.
Yeah. And so, that goes with, these also what would also make PEs, so low? Well, you get rising risk-free rates over the next 8 to 10 years, and that'll do it, right?
Yeah, and I think the assumption for a lot of investors is we have so much debt, rates can't go up. I don't know. I don't know if I could sleep well if that was my assumption. Things are so bad that they can't get worse.
That's a good point though, because that's, Lacey Hunt has been making that point for a long time.
But if inflation's at 4 or 5%, why can't rates go higher? And here's the big question: if inflation's running, let's just say 3 to 5%, and stocks fall hard. Say the short end gets to 4 to 5%, is where we were at the end of last cycle. That's not too out of the ordinary. And stocks drop 30, 40, 50%, but inflation's running 3 to 5%. How can the Federal Reserve come in and start another quantitative easing program with that type of inflation? So I think that's the biggest threat to the the safety or the safety net for a lot of today's valuations, is that belief that if things get so bad, the Fed will step in and again purchase assets.
Yeah, and I a few months ago I interviewed Bill White, who is the chief economist at the BIS, and we were talking about these topics, and one of the points that he made was, if everybody thought QE was going to be inflationary, it turned out QE was disinflationary. And so an unwinding of QE or QT, wouldn't that be inflationary?
Well, that makes a lot of sense, because if you think about the disinflation we did have, I like to use the energy credit bust. 15, 16, we were in a disinflationary environment. Energy credit bust didn't just impact the energy industry; it impacted many industries, many industrials, transportation. Prices were declining. We had an earnings recession. I think, what was it, for 5 quarters or so? We were close to a real recession. You had $500 billion in energy credit that was up in the air. People were a little concerned, but then in 2016, that sort of started to heal itself. You had the ECB starting to buy corporate bonds. Bank in Japan setting the 10-year at 0%. And that QE from both of those central banks, I think, reinflated the energy credit bust. And now, the energy companies are able to raise equity. A lot of them raise considerable equity. and debt, and we're kind of back off to the races in energy now. So that drag is now, I think, again, creating more inflation because it's demanding more resources. But the point's very well taken is the excess credit or easy money created the oversupply, which created the bust. And you're seeing that in retail as well, right? There's certain industries but that's sort of run its course too, right? There's a lot of stores that have been closing, a lot of chains have been closing. But you think about Sports Authority, right? They went out of business. Well, after that gets liquidated, their inventory, well, now there's one less competitor, right? So now Dick's doesn't have to be as promotional, and they said that in their last call. But I would say footwear is still very promotional. But my point is, at some point that excess gets taken out, and that's nice to see. One of the things I like about commodities, it's one area of the market, one of the industries that I think where capitalism still seems to function. Where you still have the booms and the busts, and you still have that volatility. So really, when the dollar got strong in 2014 or strengthened in 2014, all these commodity names got hit. That was sort of one of the areas I historically didn't own a lot of, but all of a sudden I felt there was considerable value, and that was a function of, I think, the free markets and capitalism working, and the stocks, a lot of those companies were allowed to fall considerably.
Yeah, well, you bring up an interesting point too about QE, and how can the Fed go back to QE if inflation is rising right now. And that reminds me of another thing that Bill White said to me is, there's a famous paper, I think Sargent and Wallace were the authors, about I think it's called Some Unpleasant Monetarist Arithmetic, and basically says the central bank could do whatever they want as long as the fiscal authorities kind of stay under wraps. But as soon as the fiscal authorities start to dominate the monetary authorities, then the central bank has to turn their attention to battling inflation. And I think with the tax stimulus and things that we're seeing this late in the cycle, with unemployment already at 4.9%, the Fed, and these inflationary pressures already picking up before that stuff even happening, the Fed is kind of, like you said, put in a bind where it's like, how can they go pursue QE again to save the market if inflation's running at 4 or 5%? It's to me, this is where the Fed begins to come into question.
Right. And at the very least, I think there will be a lag in policy response. So if we do have a sharp decline in asset prices, say stocks drop 30 to 50% to revert to the mean, and then maybe we do have a huge drop in demand, and maybe prices do eventually fall. But I think there's going to be a little more lag this time. And you talked about the fiscal policy, because you are going to have that stimulus. The fiscal policy at this stage of the cycle, everyone wants growth right now. And that, of course, will help. But I'm not sure if I was invested in equities right now, I would want strong growth, because things are clearly tight from a labor perspective, capacity perspective, that I'm not sure that would be in their best interest to get above average growth from here.
Well, and it's like using up your bullets that you would potentially use for the next cyclical downturn, right? I mean,
no question.
It's pro cyclical policy rather than counter cyclical, which is kind of that's why a lot of the Keynesians are like, "What the hell's going on right now?" They don't like it. But another thing that I am kind of curious as to your thoughts about is, the other side of this Sargent and Wallace papers are saying that the trouble for a central bank when inflation picks up like it is now is if the country is overly indebted and they have to raise rates to battle inflation, but they can't raise rates too much because the government can't afford higher interest rates on the debt. So, it's an interesting bind that the Fed might find themselves in. It's probably why they're not raising rates faster than they are now. What do you? What
Well, I agree.
there?
I mean, and I think we know why they're not raising rates faster. It's because of the past two cycles, right? I mean, what the policymakers learned from the past two cycles. Asset inflation is good. Just don't let it pop. Don't let these things pop. So the last cycle, they went gradual. They were very transparent. They did 25 beeps until it popped. And so this time they're going to do the same thing, but they're just dragging their feet. They're going very, very slowly. I mean, if you look at the Fed's balance sheet, it's still over $4 trillion. And again, the Fed funds rate is still below even the government's measurement of inflation. So we have negative real rates and a $4 trillion balance sheet, and we have unemployment around 4%, and clearly wage pressures and shortages and companies paying overtime. So I would say, they're being extremely cautious and careful not to deflate asset prices. But the longer they let this go on, the higher asset prices go. The Russell 2000 now is again at 1,600. It's back to its record high. It's tight. It's tight. So the longer this continues, the tighter things get. And I don't think you want to fall too far behind, whether on asset inflation or real world inflation.
Yeah, it's interesting. I think it's Ben Hunt is his name. He writes Epsilon Theory, I think is the name of his website. He talks about how narratives are really what drive the price actions in the market. And I'm surprised that this Fed behind the curve narrative is not taking off. I mean, with it so plain to see in the earnings reports. But
it's because, Jesse, if you watch financial television, again, I've been watching more because I've been boycotting my Starbucks price increases. Because when these numbers come out, these economic numbers come out, that's what these economists, Wall Street strategists, this is the truth, right? I mean, 0.1% increase, and I forgot what the wage number was last jobs report, but it was very small as well. That's the talking point that's used, and that's what is used in their analysis. So if it's 0.1, it's 0.1, right? So inflation is very low. So I think Main Street and Wall Street are two different animals, and they just see things very differently at times. Not always, but there's certain times when the bottom up conflicts with the top down, and I think we're at one of those periods right now.
Yeah, where the trend is clearly changing, it just has not been fully embraced. It's just ironic to me that you see last year the focus was on falling cell phone bills, right? Supposedly, and like that's not transitory, but all these right, and then this latest CPI report, it's used car prices are falling, and it's just picking out the one thing that is deflationary. It's see these deflationary forces, used car prices are falling, cell phone, and it's like I looked back because last year when they were showing the cell phone stuff, the first iPhone in 2007 was $500. Then we get the iPhone 10 and 10 years later, and it's $1,000. It's up 100% in 10 years. And the average cell phone bill is actually up 50-60% over that same time frame. So that's 7% inflation in the price of the iPhone, and at least 3-5% inflation in your cell phone bill. Those are the long.
Well, that and we didn't even have these things, a decade ago or 2 decades ago. It's like it's a whole new expense for us. And why aren't cars dropping like TV prices? I will say TV prices have definitely declined. That's one area the first I agree with.
Right.
We just bought a new TV, and it was amazing what you get now for less than $1,000.
Well, not only are the prices going down, they hedonically adjust them too. Because
of course. But that's we're talking about how does Wall Street or the economists not get it? But they use these numbers like the hedonic adjusted numbers. I talked about the dishwasher being installed. I mean, no one really takes the reduced quality of service into consideration when adjusting prices. But if you go from a roll down window to an electric window, it's the huge improvement, and that's deflationary. But that's not my expertise, just sort of real life experience.
Right. There's another point to the rising costs too that I'd like to just get your thoughts about. I mean, corporate profit margins have been, extremely high, for a long time now. And the tax cut, obviously just boosted them to record highs. But if these cost trends continue, right? I mean, that the companies are going to try and pass through costs to consumers as much as they can. But I mean, what are your thoughts on profit margins and cost inflation?
I think, from what I'm reading, they're, for the most part, going to be successful in passing these on. There's always a chance they don't, they announce something and they don't work. But from what I'm seeing, the psychology has changed to where it's more acceptable now to ask for a price increase. I think it was Watsco. They do a HVAC equipment. They were talking about 7, 8, 9% price increases, right? But the CEO said, clearly that's probably not what they'll get, So is it 3, 4, 5%? What do you need to maintain margins? Maybe they announce the price increase assuming you're going to get half, right, to maintain margins. So I think a lot of that's going on right now. And there's clearly some pressure on margins for certain companies. But they're responding. They're not just going to sit idle and take a hit to these margins. I think the bigger threat to margins is a reversal of the credit cycle and the ultimate decline in demand. People often talk about these new margins and they're sustainable, and maybe they are. If the business cycle never reverts. But if you plot the chart of margins next to a chart of credit growth, you'll find they're nicely correlated. So a lot of this, I think, growth in margins is often due to the growth in aggregate demand, which is closely tied to the growth in credit, right? So, I find it all very interesting. And I was talking to a friend of mine recently about, we were talking about the market cap of this cycle, market cap to GDP. Everyone talks about how it takes more debt now to generate, $1 of GDP. I tend to think it takes a greater amount of market cap to generate $1 of GDP, because we're so dependent now on asset inflation. I remember when the Dow crossed 10,000, that was a very stimulative environment. And I think this cycle, what has surprised many people, including myself and probably, many of the Fed members, is how high stock prices had to reach before they noticeably influenced consumption and demand. I wrote in a post not too long ago, maybe it was a while ago, I was like, what is the magic number? That's because, 2016, consumers were not spending very aggressively. I noted at that time, many consumer companies were struggling. And I guess I joked in one of the posts, what is the magic number? Is it down 15,000? That's about when they started contemplating stopping QE3. Or was it Dow 20,000? That didn't seem to work. But I think the magic number was Dow 25,000. That's something lit a spark there. But I think most people would have thought it would have been sooner, right? You have home prices now back near record levels. I know where we live, home prices are on fire. So I think we're there. I think this goes back to why I don't think rates are going to cooperate anymore. I think we're at a level with asset inflation that it's created more consumption, a tighter labor market. It just tightness everywhere. Again, I'm seeing capacity constraints, something I haven't seen this cycle before. So we're at a level, I think, with asset prices. You go higher from here, the bond market does not have your back. In fact, it's going to fight you on the way up.
Yeah. Yeah, it's an interesting dynamic, and I think you're absolutely right to point out, the diminishing returns of QE and the wealth effect not being quite as powerful as it was, back when 2009, 10, 11. It puts the Fed in an interesting bind, like we've talked about. What I guess to me, it's just interesting that I in terms of the profit margins, coming back to that, I'm wondering what this is. This hasn't reverted to mean like it should have. Jeremy Grantham's even talked about this. It should be the most mean reverting series in finance. And And I was hoping you might say yes, rising costs are going to
Sorry.
corporate profit margins, but it's probably it probably has more to do with the labor share of income going down so much over the last few years, and different social dynamics that have to change to redistribute.
But Jesse, it's that and the elevated demand. The productivity miracle in the late 90s. Would that have been a miracle without NASDAQ 5000, right? I mean, that was an artificially stimulated environment. That wasn't normal. So of course you had productivity miracle because demand was so strong because everyone was rich, So when you're in a recession, things are much different. Yeah, so but we haven't had a recession in 9 years, right?
So it's like a positive feedback loop that.
Yes.
Okay. Yeah, interesting.
And this is one of the things, I'm not invested currently. I'm still waiting it out. Of course, rates are higher, so it's been easier. But I'm not necessarily negative on where we are in the economy or business results. I think they're quite good. And I think Q1 was solid, and it would have been even stronger. Really, we've had a couple of good quarters, Q3, Q4, 2017. I think we would have had another one in 18. Q1, but weather is another theme I didn't mention, and I want to mention now that was a big theme this quarter. So without that weather impact, you had snow in April. It was a pretty nasty spring. Without that weather, I think you would have had another good quarter. And so I think there's a little pent-up demand you'll see in Q2. We saw this in 2014. We had very bad weather. Q1 was weak, and then we had a very strong Q2, Q3. We were on our way, and this is interesting. 2014, we were on our way to getting to where we are now. We were on our way. Things were starting to tighten up. But the energy credit bust just short-circuited that. I think it's a very important point. 15, 16, I think prolonged the cycle because of the energy credit bust. That bought the cycle time. It gave it time to breathe. We almost slipped in a recession, but we didn't. But it also was the catalyst for further central bank intervention. And we know what happened after that. Stocks again went up considerably, and credit got easy again. And now here we are. After sort of a year and a half of an energy credit bust, I think the things are back to where they were or were about to become in Q3 2014.
Right. That's a good point. You mentioned a couple times you're not invested, and what's it going to take for you to start nibbling on something? I mean, well, is it you're just not finding any micro opportunities? Is it the macro that's keeping you away?
It's bottom up. So I think there are right now some special situations you could find where if A, B, C, and D all happen, you can make money, but it just feels more like speculating to me. I was working on a micro cap or small cap. It was a specialty chemical company that sold to pharmaceutical companies. They had some generic business. The name was Aceto, and I think it's ACET. And on the surface, it looked cheap. I did some digging, and then I just couldn't get comfortable with their balance sheet. And I'm glad I didn't, because one day I woke up and the stock was down 60%. At this stage of the cycle, look, all value investors, or most that I know, they are desperate for value, right? They are desperate to find something to put in their portfolio. A lot of value managers are still required to be fully invested, so they have to buy something. So everyone is looking desperately for value, and if you find it, I'm telling you, 1,000 other analysts looked at it too. So they're right now. I'm finding there's a lot of landmines, and I just rather let everyone else run over the minefield, and I'll run over a little later and pick up the piece.
Well, that's one of the things that's interesting to me about your space in particular in the small cap world is you look at leverage among these companies, and it's just off the chart. You have people talk about corporate America has all this cash. Well, yeah, Apple has a bunch of cash, Facebook, Microsoft. The rest of the corporate America doesn't have much cash. They have a ton of debt that they've used for M&A and buybacks. And when I look specifically, just like from a big picture perspective at small caps, that to me is what's potentially pretty frightening during the next credit.
Yeah, because this economic expansion, for the most part, until more recently, and maybe the middle of 2014, has not been that 3 to 4% typical growth. So a lot of companies to meet their earnings per share targets, they had to get a little creative with the acquisitions. And when your cost of capital is 3%, it's not that hard to make acquisitions accretive. Right. But lo and behold, the rates are rising, and that debt is still there. And as you know, there's been some good articles on this recently, where the maturity walls are next 4 to 5 years. A lot of debt's coming due. Really next 1 to 3. So it'll be interesting. Right now, I'm noticing that companies are not having trouble refinancing. They're paying a little more in some cases. In some cases, they're paying a little less. So it hasn't really impacted things now, except on their bank credit. But as far as the bond market goes, it's still pretty open, and it appears that high yield investors, which a lot of small cap companies sell into, are still desperate for value as well, or desperate for yield.
Yeah, and I mean, you look at, if you're a European investor, I mean, yes, you're looking at our high yield market as juicy returns, which, to me it sounds crazy, but when you look at what yields are over there, it's I guess relatively, but in the small cap space too, I think I read somewhere that something like half the companies have a ton of floating rate debt too, so that's got to become an issue at some point.
Yeah, it's some of them may be too small to do, say, a $500 million issuance. It's pretty hard to issue $100 million, right? If that's what you need, and maybe that would do more a direct loan to an insurance company, that sort of thing. But yeah, so the bigger issuances are harder for small cap companies. So that's one of the reasons they often turn to credit lines and syndicate financing, which of course is booming as well. Just for an article, that's over $1 trillion. So a lot of $1 trillion marks we're hitting this cycle, which is pretty interesting.
Yeah. Well, that was a great. I just literally did an interview with Simon Mikhailovich, and he gives a presentation where he talks about people don't understand what $1 trillion is. It's about what's a million seconds ago, something like, I don't know, a few days ago, a billion seconds ago is like 36 years ago, I think. And then 1 trillion seconds ago is 36,000 years ago. And it starts to put it in perspective. What is 1 trillion? Well, 1 trillion seconds was, the Stone Age.
Oh.
So it's
Jesse, I'm so old. I remember when $1 million was a lot of money.
Right. Exactly right. Hey, I'm going to put a link in the show notes to your website. I think it's a must read. And I got to tell you, I've had a lot of people on Twitter say, hey, thank you so much for introducing me to Eric Cinnamon. His views have been so valuable to me over the last few months. But what's it going to take for us to get you to open a Twitter account, start sharing some stuff in more real time?
Oh man, as soon as my daughter gets out of travel softball, I think I'm going to do it. We were talking earlier before we went on about our kids and free time, and it's just I haven't had a lot of free time lately. I'm scared if I get on Twitter, I will be overwhelmed with just trying to keep up. But and real quick, another thing I was thinking about is reducing my potential buy list. It's at 300, it is tough. So
it's a lot of work.
While I'm not working, maybe I'll move that down some.
Yeah. Hey, just let's upgrade it to the top 100 or something. Give you a little more free time. Yeah. Hey, well, Eric, thank you so much for taking the time to do this again. This is super valuable, and I appreciate it.
Yeah, Jesse, I always enjoy speaking with you. Thank you very much for having me. And let's talk soon.
Looking good, Billy Ray.
Feeling good, Lewis.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and charts related to this episode at thefelderreport.com. Thank you so much for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.